Welcome to Cash Money Investing. Let's cut to the chase. We're diving into the world of options trading, and I want to be upfront with you from the start. The reality is, most beginners lose money trading options. It's a tough game, and the odds are often stacked against those just starting out. They see the hype on social media, the promises of quick riches, and jump in with no plan, no strategy, and often very little understanding of what they're actually doing. And inevitably, they get burned. They experience significant losses and become discouraged, but it doesn't have to be that way. There's a different path, a more strategic approach that can lead to success. I turned $100 into $1,000. It wasn't an overnight sensation, but a calculated journey. And it wasn't by luck, there was no element of chance involved. But by treating options like a business, with a clear strategy and a disciplined approach. My approach? It's all about a few key principles. First, learn the basics. Understand the fundamentals of options trading. Second, manage risk like a hawk. Protect your capital at all costs. And third, keep it simple. Don't overcomplicate things with complex strategies. No gambling, this isn't about betting, it's about calculated decisions. And absolutely no chasing miracle trades. Avoid the temptation of high-risk, high-reward scenarios. I only risked what I could afford to lose. That was my golden rule. My initial $100 was my tuition, the cost of learning and gaining experience. The growth wasn't a single jackpot, a lucky break that changed everything, but a series of small, smart wins, consistently building upon each other. Discipline and patience, these are the cornerstones of successful trading. Were my real edge, the factors that set me apart from the majority of traders. I said no to trades even when they seemed tempting. That didn't fit my plan, that didn't align with my overall strategy. Every trade was a lesson, win or lose, an opportunity to learn and improve. So stick around because I'm about to share my secrets, and I'll show you exactly how I did it, step by step, so you can avoid the common pitfalls and start your own journey towards successful options trading. Options can sometimes sound complex and intimidating, especially when you're first starting out, but at their core, they're simply contracts. Think of them as agreements. These contracts give you the right, but importantly, not the obligation, to either buy or sell a specific stock. They hand you the power, but not the responsibility. This transaction happens at a predetermined set price, also known as the strike price, and all of this must occur by a certain date, which is known as the expiration date. It's like a coupon that expires. There are two main types of options: calls, which we'll explore first, and then puts. You would buy a call option if you anticipate that a stock's price will increase and go up, giving you the right to buy that stock at the agreed-upon strike price. Now, if the stock price actually rises as you predicted, your call option will gain value, potentially leading to a profit. Conversely, you'd buy a put option if you believe that a stock's price is going to drop, granting you the right to sell that stock at the predetermined strike price. And if the stock price does indeed fall, your put option will increase in value. The initial price you pay for the option is referred to as the premium, and that premium represents your maximum possible risk on the trade. So, if your prediction is wrong, the most you can lose is the premium you paid up front. This defined risk aspect is a key reason why options can be so appealing to traders. In this series, we're primarily focusing on the strategy of buying options, and not on the more complex strategies involving selling them. We want to keep it simple and straightforward. Calls are for when you think the price will go up, and puts are for when you think the price will go down. That's the fundamental foundation upon which we'll build our understanding of options. Risk management is everything. It's the bedrock of successful trading, the invisible force that separates the pros from the amateurs. Without a solid risk management strategy, you're essentially gambling, not trading, especially in options. The leverage inherent in options trading can magnify both gains and losses, making risk management even more critical. Only trade with money you can afford to lose, no exceptions. This is your risk capital, the amount you're comfortable potentially losing without impacting your financial well-being. Seriously, no exceptions. Never go all in on a single trade. Diversification is key to mitigating risk. Spreading your capital across multiple trades reduces the impact of any single losing position. As my account grew, I risked just 10 to 20% per trade. This allowed me to weather losing streaks and still maintain a healthy account balance. That way, one loss wouldn't wipe me out. It's about playing the long game, not trying to get rich quick. Always have an exit plan before you enter a trade. Know your profit target and your stop-loss level. Options lose value as time passes. Don't let hope drain your account. Hope is not a strategy. Decide in advance when to cut losses or take profits. Don't let greed cloud your judgment. Write down your rules and stick to them, no matter what. Consistency is paramount. FOMO and fear can wreck your discipline. Don't let emotions take over. Trade with your head, not your heart. If a trade doesn't fit your criteria, skip it. Don't force trades. There's always another opportunity. Patience is a virtue in trading. Consistency and discipline separate winners from losers. It's not about being right every time, it's about managing your losses and maximizing your wins. Protect your capital first. Profits come second. Without capital, you can't trade. That's how you survive and thrive. Master risk management, and you'll be well on your way to becoming a successful options trader. Here's how I made my first big win with $100. I traded SPY options, liquid, stable, and perfect for learning. I bought a slightly out of the money call for $100, expiring in 2 weeks. My planned sell if SPY moved up a few dollars. The market bounced, SPY climbed, and my call doubled, then nearly tripled in value. I sold for $280 and $180 profit. It wasn't luck, it was a calculated risk with a clear plan. I didn't aim for a home run, just a solid gain. That first win built my confidence and set the stage for more. The key: stick to your plan and take profits when they're there. Small, smart moves add up. That's how you build momentum. With $280, I kept my risk in check. No reckless bets, just smart, repeatable setups. I waited for high probability trades on liquid ETFs like QQQ or SPY, risked about $150 on 2 call contracts, sold for $250, a $100 profit. My account grew to $380, then $550, then $800, and finally $1,000. Each trade followed the same process: identify setup, manage risk, execute, take profit. Not every trade was a winner, but losses were small. The wins outpaced the losses. Compounding small gains is the real secret. No moonshots, just steady, disciplined growth. That's how I hit $1,000. It's a marathon, not a sprint. My $100 to $1,000 journey proves it's possible, but only with discipline. Don't treat options like a lottery ticket. Start with education. YouTube Kash Money Channel Investopedia forums. Learn the basics, then dig into strategies and the Greeks. Knowledge is your best weapon. Practice with paper trading before risking real money. Get comfortable, make mistakes, and refine your approach risk-free. When you go live, start small, only use money you can lose. Set your risk rules and follow them religiously. Options can reward you, but only if you respect the risks. Be patient, be disciplined, and keep learning. Your success story starts with smart first steps. Good luck and trade smart, and show your boy some love with a simple like of subscription.